Welcome to StockOdds Odds and End podcast with Dave Singh and Rob Friesen. Good evening, Rob. How's everything?
Not too bad, thank you. I had a busy weekend with relatives visiting from out of town, but anyway, it's good. We're getting ready for a good week of trading, and looking forward to talking to you here. So, what do you got there on the? Should we first run through some of the futures where they are now? Let me do that quickly, and then you can roll over to the seasonality aspect. So we got the current as of today, 6 p.m. Eastern time, futures opening, blah, blah, blah. So let's just run through that quick. We got, so the Dow is up. Dow Jones futures are up 0.12, 38 points right now. S&P 0.22, 8.75 points. Russell or NASDAQ, sorry, is up 0.45, so about double the others there at 55 points. And the Russell is up 0.19 or only 3.4 points. We have had some follow through in Asia, partly because of the good rally that we had in the US for the week. And also there's a bit more reopening going on in China and so on like that. So VIX is at, what are we sitting at, 28.35, down slightly on the daily here. It's been on a downtrend since we had the big spike on June the 13th. So we've been drifting down since then. Okay, what do we see for seasonality, my friend?
Yeah, so we're the last 5 days of the month started on Friday, which was an extremely powerful day, and there's a slight difference between the last 3 days of the month and the last 5 days of the month. So the spider is expected to do minus 0.76 for the last 5 days of this month, while the last 3 days of the month is a positive 0.68. So that suggests that the last 3 days are going to be much more robust than the final five. But we did have a really strong Friday there. So a lot of the gains have been maybe skewed in there. And also the final day of the month, it's expected to be up plus 0.4%.
That's quite rare, actually, right? Because like 9 of the 12 months of the year, the last trading day of the month is down, and June is an exception to that. Now, partly because generally July is quite robust. We have very good performance for July for the S&P 500, and so that might factor into it a little bit of getting out of the gate early, perhaps.
Yeah, and end of the second quarter, there's something unique about end of June. Yeah. And like I did say, July we can expect 2.7% on average for the spider for the month of July. So it is a robust month, and it's front loaded too. The first trading day is up usually 0.53, and the first Friday. So it is a bit front loaded. So maybe some of that theme is starting early, right, with the last day of June.
Right. Any of the specific ETFs that pop out at you?
Yeah, especially for the last 3 days of the month, energy, financials, industrials, and discretionary stronger than the spider, and things that are weaker than the spider, staples, utility, healthcare. So it is a bit of a risk-on undertone with the kind of ETFs that are showing outperformance there. So, and
I think I'd be a little bit cautious with energy, perhaps. That the next couple of days might be softer, and I mean they may pop back up by the end of the month, but that's kind of a wild card. Like we have higher volatility and we have so much geopolitical stuff related to oil, right?
But the healthcare, utilities, and staples, being shorter those going into the last couple of days might be a better play. But it's kind of on theme.
Okay. Well, I know we're trading up a little bit now on energy, but we were down a bit earlier. But it's kind of hanging in there. We've had a pretty good move in June overall with oil, so I think be cautious there. As far as the, let's see, the metals are an interesting place. Do you know that copper often signals, whether we're going to have a growth economy globally or whether we're going to have recession, right?
Yes.
Have you noticed what's been happening with copper?
The slang term is what? Dr. Copper. It's kind of like the indicator, like the best economic indicator going forward. And it's been down quite a bit in June. So
June, yeah. What
that
a
could be
month.
quite bearish for the economy. Yeah.
Pretty serious move in June. It popped up slightly now off the bottom, but that's not looking good in terms of a monthly chart or even a weekly chart. It's taken out so many previous lows, so it's not looking too good at all. Gold and silver kind of hanging around, but copper's definitely indicating something's up with the global economy prospects, right? And that's the same argument that's happened with yields, where we've come down from 3.456%, dropping down to, where do we head to? 3 something now? Just over 3. I mean, it's probably sustainable over 3 rather than below 3. But again, this is the tension that we're seeing, the ongoing, whether, the Fed they're being aggressive against inflation, but at the same time, are they going to have to deal with this recession implication? And so there's a tug of war going on here, and that's partly why the market rallied off the bottom. Friday we kind of had that low, and it sprung back Tuesday, Wednesday, Thursday, Friday, kind of in expectation that the Fed isn't going to be quite so aggressive, I guess.
I think that's part of the strength in the tech stocks too, right? This drop in the yield from 3.5 down to 3.15. So that's supportive for tech. So it won't be as bad for them for the growth stocks.
Right. Looking at currencies, the US dollar is often something we do have to watch. It's still sitting up there, on the monthly, kind of took out many years there just briefly and closed within that range of that recent high, but there's a bit of an air pocket up to the highs that we saw in 2001 and 2002. So we're within spitting distance of that. So watch the dollar, see if we can gain on where we are, because it's been quite a good run here so far in 2022 for the dollar. And it does impact domestic stocks differently than it does, international stocks. Generally, when the US dollar is strong, domestic stocks tend to do a bit better. Obviously, we've had a situation this year where a lot of stocks haven't done that great, but there is that tendency. What else was I going to say? Oh, speaking of tech stocks, Shopify. Did you like the Amazon split that we had? Now we got a Shopify split. I mean, Shopify had already come off its high, but June 28th is Shopify splitting 10 for 1.
Good.
That'll then be much more tradable than it has been, so you've probably avoided it just because of the priciness for a long time. And this will bring it down into a great category. There's actually probably some upside potential for Spotify going forward. I'm not an analyst, I'm not an advisor, but just it's going to be competing more so with Amazon. And so that means that the costs for their products and their venues and their shop promise and all that will be much less than Amazon. And Amazon's, been viewed as the big bad boy, kind of in so many ways. And so Shopify might be more friendly to consumers, especially with their price point and things like that. So keep that in mind. We did see some good movement on Amazon after it split. So perhaps we get the same thing from Shopify. That's on the 28th. One thing to note this week is June 1st is a holiday in Canada. It's Canada Day. and that's Friday before the long weekend. July 4th falls on the Monday. So that weekend, often people like to make a 4-day weekend in the US out of it anyway. They also, some of them already started holidays, institutions, might be lighter. Canadian institutions are offline. Canadian investors are offline to some degree. Expect volume to be really light on Friday. Now, what's the risk in that? Well, it can be mispricing at the open when you're doing your orders. So limit orders over market orders. Number two, you can have a significant move either direction, up or down, just because it's so much lighter volume. So whoever's in charge, the bulls or the bears, expect that we could move a lot on July 1st.
It's also the first Friday of the month and the first day of the month, and both of those are bullish usually.
Yeah, so think about that. You might want to quickly, while I'm reading off some other stuff, check the seasonality for July 1st. Just to go.
Yeah, it's plus 0.53 for this Friday,
well, there you go.
And 0.29% for the first Friday. So we're looking at about 0.5% up typically on the first day.
Well, add to that the light volume and other stuff, especially if we have a bullish week overall, which is entirely possible following on the week that we just had. And if you look at your charts, that's the next consolidation level. So we had we had that period of time where we sat and chopped around, and that would have been let me put in the SPY here and just rattle that off for you. So that would have been May the 27th until we finally broke out of it on June the 9th. That consolidation zone is my target for an upside rally from this level. I'm not saying it's guaranteed to happen. It's just we remember how we went down. We went down because of a catalyst, which was inflation was higher. The Fed was going to be moving to, a more aggressive stance. There may have been other factors I can't even recall right now, like, somebody's going to press the red button for the nuclear option. I don't know what caused it. I can't remember exactly, but we did fall out of that consolidation zone and we broke down very rapidly to the most recent lows that you saw. So for us to skirt back, look at it this way. How many sellers are left right at the moment, especially when they just had a big week, Friday alone, 3%, you just had that move. Do you really want to sell into this right now, or would you kind of rather wait a little bit? I think there's enough argument to say we could cross and head right back up to the 407 to 415 area, 417 area. So somewhere in that 10 points will settle in. So we got room to move. Once we get up there, if we can't break above it, then there's an argument to sell, right? But why would you sell right now when we just started rallying?
Yeah.
So I'm going to say that the last 3 days seasonality, coupled with the first day of the month, first Friday of the month, all that kind of stuff, I would expect the probability of an up week. Okay. Now, obviously, there's things that can come in and interfere with that. But I'm helping people try to make a decision in the morning between, do you hedge or do you let it ride from the long side only? How aggressive do you want to be? Do you want your hedge standing by, or do you want to deploy it right away?
Yeah.
So if you see what I'm talking about, these undercurrents, then have your hedge standing by, but you don't necessarily need to deploy it or deploy them. Let's rattle off a couple other things here. So this week we've got earnings on Monday. We got Nike, Jeffries, Trip.com. On Wednesday we got Paychex, General Mills, Bed Bath & Beyond, McCormick. Thursday we have Constellation Brands, Walgreens Boot Alliance, and Micron. We also have some corporate events starting this week. a number of different things going on with Hewlett Packard. What else here we got? Oh, a conference. So the European Blockchain Convention, it's the most influential blockchain and crypto event in Europe. So the speakers that are being presented, you got from Meta, originally Facebook, you got Coinbase Global, you got Google, you got American Express. And that's interesting. Just make a note of that. American Express is lumped in with Google, Coin, and Meta concerning things like blockchain, right? Then you also have a conference from Wells Fargo, 4th annual Bricks to Clicks digital conference. Chewy's on there, New Skin, Real, and Box D, number of the participants, okay? We also have, make sure these aren't in your short list necessarily. You've got AMC, Cinemark, Marcus, Warner Brothers, Comcast. The reason is you've got holiday weekend, always good at the box office. You got 4 major movies out now, right? You still got Maverick running. So make sure those aren't in your list of shorts, just because I don't really see a point when you got such a catalyst behind them, both on the holiday side and the type of movies and what's already been happening at the box office. You kind of have to look at the box offices as the reopening trade to some degree that is actually in play and is working, right? Not something we're guessing at. Make sense?
Yep.
Okay. Anything else on your radar?
Any takes on market capitalization, mega caps, mid caps, small caps? I mean, what are your thoughts there? Like the last week, mega cap was up 7.87%, small cap only 4.3%. So you would think that with the risk on kind of rebound rally there, the small caps might participate more, but mega caps still did better. I mean, what are your thoughts in market caps?
Well, I mean, the small caps, they did okay for the 1 week and the not so much the 1 month. I mean, we were supposed to see for this month about 2.5% from small caps, right? And we're just shy of that right now. This last week sort of did help tremendously. But, you've got kind of this weird dynamic with nano, the real midget stocks, and the mega and the large. So institutions aren't going to go into nano. Those are retail players and stuff like that, speculators a lot. The institutions are going to go to where they're going to try to pick up some of the stocks that have been the favorites, have tons of potential, just got beat down and pulled down with everything else. And that's why you're seeing the mega and the large cap perform well. One safer area often to play in is the best in breed in the mid cap space, because they seem to be just marching along without sort of having the extreme performance either way that you see with mega and large versus small and nano, right? Like those are, you get more outlier events. You either have the mega cap really do well or really do horrible.
Yeah.
Right? And the mid cap kind of just marches along in the middle of all that stuff without having those massive extremes. That's what I've seen historically anyway. But, don't argue with this rally. If you see the signs of this continuing, you'll know. Tomorrow morning, you'll see pre-market, the indications of things. The good news is right at the moment, in terms of the futures, we're just up very, very modestly. Like we're kind of on the fence. Nobody knows. So you're going to get your proof tomorrow morning. Look at your sectors. Look at the type of stocks that are on the move. Kind of get a feel of the pulse. And if it looks like the rally wants to continue from last week, then I wouldn't argue with it.
Fair enough.
It's always easier though. Like if we open up fairly flat into up just slightly, that's a lot different than opening up, where the Dow opens up 400 points or something like that. It's frustrating because so many things you wanted to buy are already gapping. And, if it pulls back on you, there's a lot of pain. So if it opens more towards the flat side, then, it's easy to hedge if you need to. And you can deploy some longs and maybe a few shorts and see how they're going and add more shorts if you want.
Sounds good.
This whole future for the world here and war and everything that's going to be happening, it's all about energy, guys. I don't think this Russian default's much more than symbolic because, they've got 40 billion in sovereign debt. Yes, it's the first default since, early 1900s, but like they could have paid in rubles. The sanctions sort of made it that they couldn't pay in rubles, but they certainly could pay. So there's, this is a question whether it's a symbolic default or whether it's really got any teeth to it. But the worst thing is this whole thing about energy. So, for example, if there's no oil or gas coming from Russia for Germany and Europe in general, that's over 220 billion euro to hit output in the next 2 years. Like I'll give you an example. I was reading something about Germany's 11 glass furnaces. They have to keep running all the time. If they don't have gas and they have to shut them down, it's ruined, and it would take 10 years to get back to normal production because the glass in those furnaces has to stay molten. If they cool and they harden, you've lost your furnace completely. So there's just all kinds of problems that can happen from this gas supply, and I just think the future of all of this surrounds energy. Look what energy is essential for your comfort. I imagine you have air conditioning running right now in your house.
Yeah, it's 104 degrees out today.
Okay, so you got air conditioning. Well, if you had no electricity, you wouldn't be that comfortable.
No.
Well, if you're going to produce things, you need energy. If you're going to transport things, you need energy. It's energy, 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 energy. So this is where things are either going to get normalized or they're going to get crazy. Okay. I'll leave it on that note, and you guys have a good trading day tomorrow and good week. Okay.
All right. Good luck. Thanks.
All right. Cheers.